The balance sheet is a fundamental financial statement that provides a snapshot of a company's financial position at a specific point in time. It is one of the three major financial statements that companies are required to produce, alongside the income statement and cash flow statement. Understanding the balance sheet is crucial for investors, creditors, and other stakeholders who need to assess a company's financial health and performance. In essence, the balance sheet tells you what a company owns, which are its assets, what it owes, its liabilities, and the value of the owner's stake in the company, known as equity. By carefully examining these three components, you can gain valuable insights into a company's financial strength, liquidity, and overall risk profile. Whether you're a seasoned investor or a business student just starting, a firm grasp of the balance sheet is essential. This guide will equip you with the knowledge and tools to confidently navigate this crucial financial statement. Assets represent the resources that a company owns and controls, which are expected to provide future economic benefits. These resources can be tangible, such as property, plant and equipment, or intangible, such as patents, trademarks, and goodwill. Assets are typically categorized as either current or non-current, depending on their expected realization period. Current assets are those that are expected to be converted into cash or used up within 1 year, while non-current assets have a longer useful life, typically exceeding 1 year. Examples of current assets include cash and cash equivalents, accounts receivable, which is money owed to the company by customers, and inventory. Non-current assets encompass a broader range, including property, plant and equipment, intangible assets, and long-term investments. Understanding the composition of a company's assets is crucial for assessing its operational efficiency and growth potential. A company with a high proportion of current assets may be more liquid, while a company with significant investments in non-current assets may be signaling a long-term growth strategy. Liabilities, on the other hand, represent the obligations that a company owes to others. These obligations arise from past events and are expected to be settled through the outflow of economic resources, typically cash. Similar to assets, liabilities are also classified as either current or non-current based on their maturity date. Current liabilities are those that are due within 1 year, while non-current liabilities have a longer repayment horizon. Common examples of current liabilities include accounts payable, which is money owed by the company to suppliers, short-term loans, and accrued expenses. Non-current liabilities may include long-term debt, deferred tax liabilities, and pension obligations. Analyzing a company's liabilities is essential for evaluating its financial risk and leverage. A high level of debt can increase a company's financial risk, particularly if its earnings are volatile. Conversely, a low level of debt may indicate financial prudence, but could also suggest missed growth opportunities. Section 4. Equity, the shareholder's stake. Equity, the final component of the balance sheet, represents the residual interest in the assets of a company after deducting its liabilities. In simpler terms, it is the value of the company that belongs to its owners, the shareholders. Equity can be further broken down into two main categories: share capital and retained earnings. Share capital represents the funds raised by the company through the issuance of shares, while retained earnings represent the accumulated profits that have been reinvested in the business over time. The equity section of the balance sheet is particularly important for investors as it provides insights into the company's ownership structure, profitability, and dividend policy. A strong equity base can provide a cushion for creditors in times of financial distress and can also enhance the company's ability to raise capital for future growth. Section 5. The balance sheet equation, a fundamental principle. The balance sheet is governed by a fundamental accounting equation, which states that assets must always equal the sum of liabilities and equity. This equation, often expressed as assets equals liabilities plus equity, reflects the dual aspect concept of accounting, which asserts that every transaction has two sides. For example, if a company takes out a loan of £10,000, this transaction would increase its assets, cash, by £10,000, and simultaneously increase its liabilities, loan payable, by the same amount. Similarly, if a company purchases equipment for £5,000 in cash, Its assets would decrease by £5,000, cash and increase by £5,000. Equipment maintaining the balance. The balance sheet equation ensures that the balance sheet always balances, hence its name. This principle is crucial for maintaining the integrity of financial reporting and providing a reliable view of a company's financial position.